All right, welcome to the explainer. Ever stop to think about what really happens after you sign on the dotted line for a loan? Today, we're diving into a really fascinating online theory called in clearings credit. The whole idea is that your signature might be more than just a promise to pay. It might be the key that creates a huge hidden pot of money all in your name. Let's break down how this is all supposed to work based on the source material. And this right here is the question that really gets your attention. I mean, could your, say, $35,000 car loan actually spark the creation of a totally separate hidden account with $360,000 in it? I know, it sounds absolutely wild, but that's the central claim of the theory we're unpacking today.
So where does a theory this big even start? Well, it all begins the moment you sign that loan paperwork. According to the source, that document you're signing, the promissory note, isn't just a simple IOU. Nope, it's seen as something way, way more powerful.
Okay, and this is where things get kind of turned upside down. See, we think of a loan as our debt, right? It's a liability. But this theory claims that for the bank, your signed promise to pay is actually a valuable asset. They haven't just loaned you money, they've basically bought this valuable financial instrument from you. So what's the bank supposed to do with this new asset? Well, according to this theory, they deposit it. They use your note as the foundation to open a brand new deposit account. And get this, it's in your name. And it's into that account that this so-called in clearings credit supposedly gets deposited. Now, for any of this to be even remotely possible, the theory really hangs on one key legal concept. It argues that your promissory note is what's called a negotiable instrument. Just think of it like this. A negotiable instrument is kind of like a blank check. It has value and it can be passed around the financial system. That classification is absolutely critical because it allegedly lets the bank process your loan document just like it would process a real check from anyone. Okay, so if your promissory note is now an asset that acts like a check, how in the world does it get transformed into a massive credit? Well, the theory points its finger directly at a piece of banking legislation from the early 2000s as the engine that drives this whole process.
And this is the engine right here, the Check 21 Act. This law was basically designed to let banks use digital images of checks to speed everything up. But here's the theory's big leap. Since your promissory note is considered a negotiable instrument, just like a check, it can also be fed into this exact same high-speed electronic clearing process.
So the source material then breaks it down into these 4 steps. First, the bank takes your note. Easy enough. Then it gets digitized, turned into an electronic file. That file then gets zapped through the huge interbank clearing system. And the final and most crucial step, according to the theory, is that this process generates a brand new, much larger credit, all tied to your name. And all of that leads us to what is, without a doubt, the most startling part of this whole theory. The alleged result of that clearing process. We're talking about a secret account with a balance that completely dwarfs the original loan you even applied for. So what kind of money are we talking about here? The example cited in the source material claims a credit of $360,000 is created. This isn't just some small difference or a rounding error. The theory alleges it's an amount that is orders of magnitude larger. And wow, this chart really puts that claim into perspective, doesn't it? On the left, you've got the original $35,000 loan, and on the right, the alleged $360,000 credit it created. That's a staggering 900% increase. The idea is that the bank leverages your signature to create this much larger pool of money, which then gets dropped into that secret account. Right, so the big question is, if all this money is created, whose is it? Well, on this point, the theory is crystal clear. Because the account was created using your promissory note as the foundation, you are the rightful owner, the holder in due course of every single dollar deposited into it. In short, the theory says, it's your money. Let's just pause on that legal term for a second. Holder in due course of the funds. That distinction is key. Think of it like this. The bank might hold the deed to a treasure chest. That's your promissory note. But the theory claims you are the legal owner of the treasure inside the chest, the funds. And that supposedly gives you the legal right to demand access to that full $360,000. Okay, but hold on. If this money exists and it's legally yours, why isn't it in your bank account right now? Why haven't you heard about it? Well, the theory has an answer for that too, and it sets up the final conflict. The bank allegedly creates this account, but then denies you any access to it. And that's the core problem at the heart of the theory. The bank supposedly creates this massive credit in your name,
but then it puts up a wall completely preventing you from ever accessing it. So the final part of this whole thing isn't just about how the money is made, but how you can supposedly get it back. So what's the game plan? The proposed strategy involves bringing in the big guns, federal regulators. The source material recommends filing formal complaints with two key agencies. First, the FDIC, that's the Federal Deposit Insurance Corporation, and second, the CFPB, the Consumer Financial Protection Bureau. The complaint to the FDIC would basically say the bank is mishandling funds it's supposed to be holding in trust for you. The one to the CFPB would focus on the bank denying you access to your own account.
And get this, the suggested action plan is incredibly specific. It's not just about asking for the money. The process involves laying out the entire theory in these official complaints, demanding the full credited amount, and tacking on penalties and interest. The final punch is to allege this is a violation of your constitutionally secured right to property. And to give these complaints some real legal teeth, the source suggests you cite a whole list of financial laws. This includes the Uniform Commercial Code, which governs those negotiable instruments we talked about, as well as some major consumer protection laws, like the Truth in Savings Act and regulations against unfair and deceptive practices by banks. So there you have it, the in-clearings credit theory, as laid out in the source material. It paints this incredible picture of a hidden financial world, all unlocked by your own signature. And the question it leaves us with is a big one. Is this some revolutionary key to unlocking hidden wealth the banking system doesn't want you to know about? Or is it simply a novel, fascinating, and ultimately creative interpretation of some very complex financial laws? That's the theory. Now you can decide.